Hi, friends. This is Dr. Meherji. Welcome you all to the today's session. That is value investing strategies. Value investing strategies. Many of us are very interested in investing in the markets. I mean, that is stock markets. But whenever you inquire anyone or you might be feel on your own that many are incurring losses. Why it is happening? Because that lack of value investing strategies. So that's why I framed this session. The main agenda of this session is core principles of value investing, to discuss about the key metrics used in value investing, steps in value investing process, and to recollect the famous value investors and common pitfalls and tools for value investors, and summary and takeaways from this session. So once again, welcome you all for value investing strategies. The core principles in value investing are estimating the intrinsic value. Intrinsic value means it is the true value of the asset in which you are going to invest. Say for instance, if you are interested in investing in a company's share, first of all you should know the intrinsic value of that particular company's share. That is not the market price of the share. What we are looking in through channels or through that newspapers and all, that is the market price. Market price is different and intrinsic value is different. One should know the intrinsic value of the share. Thereby you can expect the margin of safety for your investment. Thereby you can get the margin of safety of your investment. And the long-term investing focus in value investing strategies. So if it is a short term, almost all companies shares, whatever that investment may be, they will fluctuate for the short term investment. To overcome it from that is long term investment only. So you buy today and by investing today and looking its appreciation by the end of a week or month, it is not advisable. So your investment strategy should be long term so that you can get good results from your investment, good returns from your investment. So here in value investment strategy, what we came to know, that is, first you have to find the intrinsic value of the asset in which you are interested to invest. thereby to get its margin of safety, and then long-term investment strategy, long-term investment policy. So, what is that intrinsic value? It is the true value. So, how to identify that intrinsic value? We will see it in later steps in the same slide by using different key metrics. Okay, and next step is fundamental factors. Value investing prioritizing fundamental factors, emphasizing more on financial stability over the market trends. Thereby, we can avoid hype-driven decisions. Okay, say for instance, market rumors are spreading. Okay, a particular company's share is going up every day. Why don't you invest? Or why don't I invest? Okay, in one fine day, we'll take 2-3 days time to think over it, and in a particular day, after 3 days or 4 days, we will invest or we will buy that company's share. Thereafter, immediately it will start falling. Every investor is facing the same problem in the market because it is hype driven decision. So kindly avoid such hype driven decisions in your investment strategies. So one should prioritize fundamental factors only and emphasize more on the financial stability over the market trends. Now we will see the key metrics for value investing. First one is price by earnings ratio, price to book value, price to investment, that is capital value, and return on equity. These are the key metrics to effectively identify and invest in undervalued companies with growth potential. With growth potential. The investment policy should have the purpose. What is the purpose of our investment? It should be long term, as we already came to know that to avoid short term fluctuations, we are creating a long term portfolio plans only, and thereby you can create asset allocation in which how much percentage you want to invest. Diversification in investment is first principle in any investment strategy. Thereby you have to invest your hard-earned money in different sectors, not in only one sector. So anyone is saying that what is meant by investment, simply they will say it is an investment in the equity shares. Okay, it becomes fancy. Even SEBI is giving alarm signals to all, and that too options, buying and selling of options. Okay, sometimes it gives 200 rupee and it will take away 1000 rupees. When losses comes, it is 1000, and whenever you are finding the profit, it is 200. Ultimately, you would be in the loss. So everyone is facing the same issue, though they are investing in the same platform. Again, they may say where we lost, there only we have to search, or there only where we have to find our lost money. But that will dip and again dip in a lot of troubles. It will place you in a big troubles. So avoid such investment strategies. Review anticipated returns under risk levels. Okay, over a period of time, how much return you are anticipating and how much risk you are perceiving. Yeah, okay. So even at this stage also, okay, you want to buy a particular company's share at 1,000 rupee. You are expecting over a period of 5 years, you are expecting it becomes 4 times, 4x. That is 4,000 or 5,000, like that your expectation. At the same time, okay, how much loss you are looking at. Okay, it may drop up to 800, and thereby market is subject to fluctuations. Everyone knows by this time. So your investment 1,000 may not go uh, at a 90 degrees or 45 degrees over a period of time to reach 4,000 or 5,000. It will face so many fluctuations. Immediate after your investment over a period of 6 months or 3 months, it may touch 800 or 700 or 600. How far you can sustain or bear that loss, that one also should be in your plan. Okay, if it dips up to 800 only, I can bear. Beyond that, I cannot. So that is your stop loss. Whenever it touches 800 in that time span, you sell it off and come out of that investment. Or else, it is going as per your plan and with the God's grace. Okay, it is going immediate. Your 1,000 becomes 1,500, and thereby again it come down to 1,000 rupee. Yeah, even though there is no problem, your invested money is safe. 1,000 rupee is still 1,000 even after 1 year or 6 months. No problem. You are losing only the interest on that investment. Again, you have still good hopes. Okay, it will bounce back. Again, 1,500, 1,600, 1,800, like that. So 1,800 and again it come back to 1,200 and again it bounce back to 1,800, 1,900, 2,000. Okay, you are keeping your invested money in that particular avenue like that, and it will touch your target amount, say 4,000 or 5,000, then only you will come over from that investment. If it is not so, it is touching. Okay, again it come back to 1,000 and again it is falling back beyond 1,000. It is going down. Okay, it is better to sell it off whenever it touches 1,100 or 1,200 or even at 1,000 rupee. It is better and you can invest in some other company's shares. So one should keep it in mind that review of anticipated returns and the risk levels also, that we more often will call it as risk tolerance, and establish ongoing review schedule. Okay, every time, okay, if it is a particular share, I discussed so far, it is an individual shares performance and what you have to do. And in case of it is a portfolio. Portfolio is better than individual investment, what we said. But for your better understanding, I discussed about a single shares performance. But in case of portfolio, in that case also, okay, your invested portfolio asset, it consisting of banking company shares and real estate and infra and oil and energy. So like the different sectors of whatever you like. Okay, FMCG, it is fast growing. So in that sectors, okay, you pick what are the top companies, what are the companies which are having a good growth. You find like that earlier metrics we discussed. Using that metrics, you find out which companies shares are having good growth prospects. In that you invest and you look into that portfolio value as a, say for instance your portfolio investment is 1 lakh, and within 1 month or 2 months it becomes 1 lakh 20,000 or 1 lakh 10,000. Yeah, it has given extraordinary returns. Okay, keep it up as it is. And again you see whether any reshufflement is required in that portfolio. If it is not so, no problem. Or else, in total, say for instance, in that portfolio, you have 10 assets, but only a few 8 assets are performing well and 2 assets are not performing well. Example, that asset, I mean, it is 8 different companies shares, and the 10 companies shares and 8 companies shares are performing well, whereas 2 companies shares are not performing well. You need less to carry on them with that losses. Okay, you can rethink whether it is better to replace with some other performing assets, performing companies shares. So you will reshuffle it, establish that ongoing review schedule, and thereby by drafting all that, framing this policy implementation, and then you implement it. Implement this investment strategy in a wise manner, and pays in asset-based advantageous pricing, and then confirm your portfolio details, how much should be it has. And I mean it is not only that all that companies shares only. Okay, a wise portfolio will consist of some companies share, investment in the company's shares, some share in the debentures, which are fixed income instruments, that is the debentures, treasury bills, like that. They will guarantee some returns uh, to your investment. And gold and silver, yeah, bullions, that means. Okay, gold and silver, okay, growth rate is less, though it will raise. And if your investment amount is high, okay, it will, your portfolio will consist of real estate also. So yeah, a good theory or principle, whatever you call, that is, okay, landed investment is very wise. Okay, by applying economic theorems and rules, what they are saying, land is limited and population is growing like anything, and the demand to land is increasing like anything. So thereby investment of your money in landed property is definitely a wiser one, but at the same time you have to see the problems of litigation and all, legal problems and liquidity problems, all that are very high in case of real estate. That one also one should keep it in mind while making investments. And now we will see famous investors and tools. You all know so Benjamin Graham, the father of value investing. He authored a book titled The Intelligent Investor. The Intelligent Investor. And another one we all know very well, that is Warren Buffett. He emphasizes more on quality in his investment strategies. We also have to look into that value investment. Quantity and quality. Quality is more important in our investment strategies. And modern practitioners, notable figures like Charlie Munger and Seth Klarman, they are offering unique takes on value. Greenblatt and Marx contribute significantly for this value investment. So, for making a value investment, what are the tools? Already we discussed, okay, where it would be available. Okay, see that resources like Morningstar and Yahoo Finance, which helps investors to evaluate their stocks. Uh, Once again, I am taking you back to that. The key metrics you see here, the key metrics, P by E, P by B, P by FC, F, and ROE, all these metrics you can find very easily here in this uh, site, Yahoo Finance or the Morningstar, like that. So by using these tools, Finviz aid in screening for investment opportunities, which stocks are available at discount, and thereby we can take a value investment. At the same time, the common pitfalls and the risks while making these investments are first one, it is value traps. So for instance, price to book or price to earning, it is okay, very cheap, okay, it is available at very discounted price. Okay, one is much fond of buying that company's share, and whenever it is falling further and further, he goes on adding that stock by making more and more investment on that. Okay, it may be a trap. So one should be more vigilant. We will call it as a value trap. What that is, it is that such companies may have fundamental problems, fundamental issues. So, and that company may be, or even that industry, entire industry, may be a declining industry. In that case, the company valuation goes on eroding day by day. So, one should not fall on the value traps. One should be more vigilant whether he is facing such a value trap. And next one is quality factors. Assessing quality factors like company culture, leadership. It is most crucial for any value investors decisions. Okay, one should see that qualitative factors also. What are the company culture and what is the leadership? Okay, numbers alone don't ensure a robust investment. Qualitative. Whenever we are looking into this financial statements, example, okay, we will see only quantitative factors only, quantitative figures only. With that, we cannot judge a particular company. Thereby, we cannot make an investment. Thereby, qualitative factors also one should consider. And last but not least, that is over reliance on ratios. Over reliance on ratios. One should avoid this thing also. We should not rely blindly on the ratios. Yes, these ratio, these all these metrics we seen earlier that are ratios only. At the same time, over reliance on ratios also not advisable for value investors. I hope you understood and you got something from my uh, inputs, and you can take little steps to become a value investor rather than a hype driven decision making investors. Don't do like that, and you all uh, should become a value investors, and thereby your investment should become a double, triple as you expected in the uh, estimated time, whatever you have framed like that it should be happened. Okay, that summary and takeaways of this session is we uh, discussed about this intrinsic value, that is the true value of a company, and a margin of safety in your investment. Utilizing key metrics for identifying these potential investments, and what to follow for investment process, and we learned something from famous investors and available and utilized uh, tools by them, and be aware of that pitfalls and the risks in value investing practices. Uh, and with this, I am concluding this session. Thank you. Thank you, one and all, for sparing your valuable time.